Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Igor with us, and I'm going to let Igor pronounce his last name for me since my Russian is not all that great. But Igor, it's great to have you. I just would love to hear kind of your origin story of how you came from Moscow to LA and got into commercial real estate.
Bruce, thank you very much. It's a pleasure, you guys, right? And thank you for listening, everybody. My name is Igor Shaltonov, and I just say Bruce because he's almost to trip over right over that last name, and that's a powerful move. I just throw that last name and say to people, try to pronounce that thing. So, anyways, from Moscow is, I just want to kind of get you guys to Russia 1990s. I would say it's early 90s or so. Let's say mid 90s. Let's not talk early. So just to put it in perspective, it's a little civil war, right? Just imagine there's darkness, no food, nothing. No YouTube, by the way, right? No books as much about a real estate investing, right? And even so, my mind, what I heard once right outside of my apartment, on the street, my friend saying, listen, I'm going to go pick up cash from people. I was like, can you stop for a second? What do you mean pick up cash from people? He said, oh, you know what? We got spare apartments, so we give it to people and they actually pay us money. I was like, dude, can you tell me more about that? What do you mean? People, not everybody living for free. You actually need to pay for this thing. I was like, wow, really? And I'm probably like 10, 12, 13. I'm not sure what's the year was it. And that's kind of struck my mind back then. That's what when I sit down once, right, when I was like a little bit older, I was like, where did I hear first time ever the people can exchange money for a place to live? Okay. Wow. Now think about it. It's a communist party, right? There's not open market, right? There's no stock market. There's nothing, right, back then. And people already did something like that. So, and I would just revert back to time. It's probably was for elite, right? To have that type of access, to have access of real estate or a place to live, and you give it to other people, not just for free, but for money. So, yeah.
Wow. So there basically was a capitalistic market within the communist regime, so to speak.
I make an assumption of that, right? It's got to be so, right? There were properties, there's multiple properties, right, under one name of the guy, right? What he's going to do? He's not going to, just keep them empty, right? They probably rented for people. It was a market for that. It was pretty big real estate investors. But again, who knew that back then?
Wow. Okay. So fast forward now.
Yeah. Fast forward, right? Again, for me, it was the aha moment, if I remember that back in my younger ages. But then, so when I start to make money being a professional athlete, I was like, okay, there's a place actually. So because I want to be illiquid, and that was on purpose. That was by design.
Right.
It's not like a stock market or some type of, the financial papers when you just click and sell it, or you just give it to someone to sell it immediately, right? And the real estate gave me that layer of, illiquidity. There's no emotional decision could be made, one. And then two, it just keep growing. So I understood that way later, right, in my life. So, but it just keeps growing and you have a cash flow, right? Again, when you have money coming in, you don't think about that thing. But then the problem was professional, right, athletes. So you think in the moment, right, when you have a contract, you think it's going to be forever. Right. And then real life it just for, NFL, not for long. That's what the NFL guys tell me all the time, right? It's acronym for not for long, right? And then that's true, right? Because average career for any professional is between 3 to 5 years average. Right. We're talking about. You see some outliers, 20 years, LeBron James still cannot retire, right? Why? Because he's got amount of pressure, right? From, endorsement, probably money, contracts. We cannot sell tickets if you retire, right? And all that stuff. But what I'm saying is, so the reality, you got to be prepared and you do not understand in the moment. But then once you stop, you're like, oh, you know what? I have this asset. I have that asset. I did this. I did it while playing. So that was my case. And I was thinking through that. And then we got one place And then I talked to my mom. I said, listen, so we can do real estate. And she was like, what's a real estate, right? And then I just explained to her, she saw some cash flow, right, coming in. And by the way, there's no mortgages. Forget about mortgages, and there's no mortgages. You got to have a cash to buy certain things. If you want to buy cash, you save for a couple of months, you buy a car, right?
Yeah.
So if you want to buy apartment, you save for like a couple of years, you buy apartment. So, and that was the case with us. We have like extra cash, so we just purchase assets. It's cash flowing, and at the end of the day, so it's actually always growing in price, right? Why? Because of inflation pushing. Again, those are all things I learned later in the life, but then that was the beginning of my mentality and the mindset. And fast forward, when we moved to United States, my idea was if I did single units, meaning so buying apartments and then renting to the people, why couldn't I do it here, right? It took me some time to build a business first. So we opened Basketball Academy. So I would say probably 5 years I didn't invest any real estate. It was still Russia. And then I was not thinking, because I was like really building a company, right? Hiring new people, opening new offices, like new gyms and stuff. But then when they start, there's usually like there's one stage and then another stage. Now you all of a sudden you build a customer base, the cash is coming in. So you're kind of on the plateau, right, of growth of your business. Like, what do you do next? Okay, there's another real estate play, so we can buy single family houses. That was my mind. And when I bought the first one, the idea was, okay, in my portfolio in Russia, my mom was actually mentioned this. And the reason why, because it was like so simple. People are not used to the law on the tenant side. I would put it this, like very gently, right? So they just give them the key, right? They pay you monthly. Barely they request to do anything, and they fix it themselves a lot of times. It's lower income as well, so they will never bug you with a lot of different like small things. When I got it here, like, oh, we got, the switch is not switching. Can you switch it for us, right? So can you flush? Can you flush the toilet? Can you close the curtain? I was like, dude, like what? And then so that was the change, right? I was like, oh my goodness. And then you got to serve the notice, right, of vacate. And then you got a 3-day notice. And you got this, and you got this. I use my employees actually I actually fake sometimes and then put my employee in the black suit. I was like, can you serve that notice to my client? Because he's not paying me for a week or so. And then actually he paid me. Anyways, I start to realize it's different. And then the law is so much favor on the tenant side.
Yeah.
Especially in California. I bought it in Reseda, California, first house. And then so that I was like, okay, if I have this and I multiply that by 10, and I'm waiting on the play of the, on the just equity growth, right?
Right. Yeah.
And I was like, oh, how's my life is going to look like? This isn't that passive, because what they sell you online, the real estate is a passive investing. It's not. It's like a super aggressive active investing, right? And then if you got single family, it's like a double active. It's not like it's called single family, but it's a double active, right? Operation.
Right.
And then I was like, I'm not going to do that. So this is not my, if you got multiple businesses and you got the investment portfolio like that, your life is going to be like just a chaos, right? Unless you have enough cash, right, to just subsidize the property management and share like a large piece if it's single family. If your portfolio is not in 100 units, it's going to be tough to negotiate, right? Any meaningful fee, right? And so basically what I'm saying here, I was like asking my mentors, I would say on the business side, like, what do you guys do? Like, I don't see you own like 20 single family houses, right?
Right.
And I'm talking like back 2015, right? And they say, like, how do you play that game? I was like, oh, there's multifamily play, right? So there's one, and I want to mention that too. I think there's a bigger pockets back then, like 2015, 16.
Yeah.
You remember Josh Dorkin, and then the Brandon Turner, he just joined him as well as a co-host.
Okay, right.
There's a lot of info I took from there.
Yeah.
Like I would listen for a book they mentioned. I was like, I'll read it. Like I was like my brain was so aggressive on that. Whatever they called, whatever they say, I'm gonna read it. Like just consume all of it. Like the podcast, the book, the people to listen, right? And stuff. And I think the first one ever, it was Kathy Fetike. And her
Oh,
story, I'm not sure if you heard that ever, but she's actually from up north. She's from San Francisco area, and then she moved to Malibu. And she was like talking about, oh, we just purchased the 300 unit apartment building, and I'm just own like single family, right, in the United States. And I was like, oh my goodness, like a 300 units. And then she's saying, oh, we just developed the Utah Deer Valley Hotel for like 1,000 rooms. So I was like, oh my God, like 5,000
right.
rooms. I was like, that's my dream. That's somewhere like so far away. Like when I'm going to get there, like, I hope so, right? And then I think 2017, I start to realize, I don't want to build a portfolio of single family houses. And then on New Year Eve, it's one of the things you do, like you put the wish on a
Yeah, right, right. Yeah.
small
Okay.
paper and you just burn it, right? And then you put it on a champagne glass and you basically just drink it. I don't remember, it was 17, maybe 18, maybe even 19, probably 17, 18. And then I made a wish. I want to buy apartment complex. I wrote
Uh,
it down. I just burn it, right? And then
yeah.
I think it was 19. I think it was 19. And then that year I didn't buy it because the problem in my mind was like it's a large kind of scale. If I fail, what I'm going to do? I would love to get a partner in that. So I met my partner, and the guy like threw out my mutual friend, and the guy was like, "Oh, I'm sharing my idea." I was like, "Dude, I want to buy apartment complex." He was like, "What?" He was like, "I want to buy apartment complex." Like, I thought he was gonna tell me you stupid or something. He was like, "Dude, that's my dream. Like, let's do
Oh,
it."
wow. Oh, wow.
Yeah, and then so we just bunched together. So instead of buying right away and doing something like that, we said, listen, how can we learn? How can we become, small piece of something large so we can start the learning curve process, right? We're not just jumping into $20 million failure, right? And then if something wrong, so we just completely bust it. So we just say, okay, listen, if you got a big guys, can we join them somehow? And then here's where I hear from Fetike, the syndication model. Like, I was like, what syndication model? I said to research because, again, my thing was if I'm part of it, I start to listen, I start to learn, and say my brain will jump on it, right? You start to understand the model, how it works. And that was my next step. I was like, okay, let me become the a limited partner at least in 10 deals before I start to talk to somebody about that, right? I want to make sure from inside what's going on, right? And we start to actually invest in different projects. Okay, let's do one in California, let's do one in Florida, one in, I don't know, somewhere else, like let's say Arizona, right? And stuff. And that's how we build our like understanding of the model first, right? We start to really
Yeah.
understand how it works, what type of assets, where we fail, where we lose money, right? I want to lose money a couple times before I talk to people as well. So, and this is exactly what happened. And we start to really understand the model. And, now it came out to before I can actually talk to somebody and say, listen, do you want to be part of that deal? I want to make sure I fail a couple times. And then, so the best product will be going to our investors, right? And our like customers. Yeah, I'll stop here, Bruce.
No, that's fantastic. So you started down the road, you failed a little bit, you succeeded a little bit, and now you're going into syndication. And now, right now, what's happening right now in terms of your marketing and your purchase of different assets? What are you thinking at this point?
Yes, so I think the learning curve was important. And the reason why, let's say we got in 2020, 2021, right? So the market was hot, like
Oh
medium.
yeah,
So I'm talking about after COVID-19 times, right?
right.
So everybody was talking about apartments, the best investing, right? The private markets and stuff. The 2023, 24 was the worst time probably ever. And the
Right.
reason why, if you invested in 21 rates or so, you're probably most likely going to get capital call. You just busted or you lost the principal. So, but there are some really good operators. There are
Yeah,
some good deals, right?
right.
And then, so let's say we lost the money in a couple deals, but then we learn, and I feel like we did it intentionally. For example, we did like ground up development.
Oh
That number,
wow. Oh
that
really?
number. Yeah,
Oh
so the
wow.
ground up development deal, not our by ourselves, but we invest in that deal. So, and that was a learning curve. So if it's not built, it might never gonna get built because it doesn't exist. Just put it in
Right.
simple
Right.
perspective. It's not there yet, right? So from point of, oh, it's an idea, right? What is that? It's an idea on paper, right?
Right,
Then that
right,
idea should actually realize in the real world. So that might not happen. It could be
right.
like 1,000 times the best developer of the year, right? I don't know. They've been doing the deals for 45 years. Who cares? So this is an idea. It doesn't exist, and it should be like existing in 3 years. So
Right.
that was a good learning curve, right? And then whether with something like which has already existed for 20 years, and you just purchase that, and you're trying to do minor changes. So the chances of those are like gone, or it's
Oh
like
yeah.
minimal, like it's almost zero. Could be a problems if you cannot operate this thing, but then it's not going to just evaporate, right? Or it's not going
Mm.
to disappear because it's a brick and
Hmm.
mortar business. So, and that's what we learned. And then the second learning was, okay, they could be a really good deal, but then really bad operator, right? And that's going to get busted too, right? No matter what you do, right? Because that really good deal will become like terrible. And that we learned that one too, though. And
Wow.
then some, yeah, we had that example too. So, and then the other example was, okay, very boring deal, not looking good on, when you show up right to the property, but then all of a sudden just cash flowing and just keeps cash flowing no matter what their market is, right?
Wow.
And
Yeah.
so again, it took us a little while to understand what we actually want to bring to the customers, but that was the process. That was the history, I guess, though.
Yeah. No, that's fantastic. So looking to the future over the next year or two, what do you think is going to happen?
Yeah. So in that learning curve, I think we learn, and whatever we do, we want to make sure we got downside protection, meaning it's existing building, 100 plus units, right? We got really good data on it, meaning so it's not flexible, right? It's not just going to go spike. And then, so for the next, I would say from today for the next couple years, we like really boring regions. Nobody's talking about investing in Kansas. Nobody's talking about, I mean, they start to talk about North Carolina, right, and Arkansas and stuff like that. But then those are the markets we saw in the really in the downturn, right? They're not just affected as much. Like
Right.
they might not growing, right? They might not growing crazy,
Right.
but who cares if your cash flow just coming in every month, right? So the
Right.
rent is a monthly payment, right? It's not 5 year check, right?
Right.
So if you focus on this first place and you just make sure you got positive leverage day one, so they're not pitching you on saying, you know what, in 2 years when the rent is going to go 3% every year, we're going to start to get cash flows. Like, okay, good luck, you guys. Right? What about those 2 years where you're going to be? So what I'm saying is this is just a something for the next couple of years just to really consider if you guys looking at the deal. Make sure you got positive leverage. When I'm saying positive leverage, the interest rate on your loan, right, and then the cap rate. So you got a little bit of the spread. So we got this, the cushion for the cash flow and the cushion for your mistakes, like honestly. So if you did something wrong, so you're not gonna get like bankrupt right away. You're not gonna lose that deal, right? So you get some cushion for mistakes. And then the second idea was, okay, if I'm in Dallas, right, or let's say Arizona, and it's oversupply for the last couple of years, there's no way in the world you're going to be raising your rent, right?
Right. Right.
Unless you're in like very specific area, it's like ultra something like rich or maybe popular or some great school and stuff. There's might be like rare cases, but general market, right? If you got 10,000 units coming online like this year, so it needs to be absorbed, right? And the absorption rate is 7,000 units. You got another three. Now you got to fight all the concession. Now you're trying to find right, and you actually fighting over that same tenant. It was like 10 different buildings. That's going to be really hard to survive for the next like 2-3 years. And then, so what I'm saying, and you build your assumption on that, that's going to be insanely hard to actually beat those assumptions. And what I'm saying in the boring markets, right, the rent was like $1,200 2 years ago. It's became 1250, right?
Right. Right.
Like a couple years ago, and then the year before was like 1275. So there's still stable growth, and then if you have that positive leverage day one and the stable growth, you're not going to get, let's say, 10x in 5 years, maybe, right? 2x in 5 years, sorry. But then you're going to get your like projected return, and you're going to get your distributions consistently, and you're going to get this exit as well. Why? Because they're going to be based on those performance for the last 3 years. So that's what I'm going to say for next couple of years. Just look at positive leverage. Look at the markets where the last 2 years was still positive rent growth, right?
Mm.
That means there's still demand for that, right? And it's going to be like that or better, right? When the economy turns, and be boring, be freaking
Be,
boring.
be boring. I love it. I love it. So I'm curious, how much are you leveraging your purchases? Like 60, 65%?
Last two, yeah, the last two was 65%.
Yeah.
So one of them was loan assumption as well, so which
Oh,
helps a lot at 3%, for example. It's
oh,
when you
wow.
get this
Okay.
blended return between like a market rate today, which is going to be a little bit less money, right? And
Yeah.
then you doing this large portion of assumption, right, which is at 3%. So blended probably around 5, which is the cap rate was 6.1.
Yeah.
So you have that 1 point, right, of the
1%.
positive leverage, and it's a huge on amount of cash coming in monthly. So
Yeah. And so you're right now focusing on 100 units or larger
yeah.
purchase. Yeah. Yeah. You've tried the smaller ones, you've done single family, and now you're convinced the larger units are the ones to go for.
Yeah, and again, so it's all possible if you the company who owns like I don't know, let's say 5,000 houses. Okay, let's say 100 houses, right?
Yeah.
And you
Yeah.
have cash flow inside of the deal to manage, right? To hire a property management company, right? And they'll charge you like minimal. Why? Because you got large portfolio. They're not gonna call you every night, right? So
Mhm.
they're just gonna
Mhm.
send you a report, right, every month and stuff. That could be a play, right? The
Yeah.
2020 was outlier when the equity of the houses just exploded, right? And it just, I don't know, was 30% growth, 40% growth in a couple of years. Is
Yeah.
that going to happen again? It's hard to bet on it, right? Can we
Yeah.
go down 40%? I don't know, maybe not. So, but again, so this is the probably the things assumptions we're living in right now, right? But then, can you really base your business on that, like on the future assumption of equity growth? I don't want to be part of this thing, right? I want to be
No.
more
No.
stable. That's one. The second thing is like if you invest in apartments today, right, and just to be able to purchase your own house, right? So you got to work at 3 tech jobs, right? You make $1 million a year, right? After
Right.
tax,
Yeah.
it's gonna be
Right.
five
Yeah.
hundred thousand, right? I'm talking about California again. Sorry, guys.
Yeah. Yeah.
And then, so I mean, how many of those guys you have right on the streets? Like almost nothing. And then, so you got to leave somewhere, right? You got to still leave somewhere. Where are the people going to leave? Can they
Yeah.
afford to rent a house? Possibly, but then the cheapest way to leave historically in the United States is apartments,
Yeah.
right? And then so 90%, or say 80% of the people will still live in apartments, right? In apartment complexes, right? That's the way in. All the young people will live in apartment complexes. The reason why, because the affordability factor is like below, like I don't know, when it's like 3 times right now or so, right?
Right. Right.
Historically, it was kind of close, like close to affordable, and now it's like not even, don't even
No.
think about that, right?
No.
So what does that mean? That means for the next 10 years, everybody will be most likely living in rents. So I'm talking about the people who was 20 and then now all of a sudden 25, right? Where are they going to leave? And that's going to be the wave of those people, right? Coming to market and saying, so I'm not going to buy my house, but I want to live in a good apartment, right? And then, so I feel like we play in that trend, and then it's more predictable. Why? Because if the market goes down, right, all of a sudden tomorrow's stock market, right, you still need a place to live, right? You're not going to live in luxury places. You're going to be in decent apartment complexes, right? So what are the chances you're not going to pay rent? So it's minimal. So you diversify between the hundreds of different employers, right? Because again, somebody employed by this company, somebody by that, right? So what are the
Yeah.
reasons they all default on your payment tomorrow, right? It's very minimal, right? So you might get a little bit of turmoil for 12 months or so. I'm talking about like drastic economic
Right. Right.
volatility, right?
Oh, that's an interesting analogy. Yeah. Right.
Yeah. So and again, okay, looking back in the history, 2008, 9, right? So they
Yeah.
recovered the fastest, and the reason why, because like I would rather buy ice cream or pay for rent. So you need to shelter, right? You gotta pay for shelter. You gotta, sleep somewhere. You gotta, hang out somewhere, get some rest somewhere. So and people, that's a priority for people. They'll pay first, right? They'll find the money. So and it's usually the COVID was a good indication as well. They were paying rent. They were not paying cable TV, but rent they will, right? And stuff like that.
So, just to summarize, which I think is great, is basically look for boring, look for steady income. Maybe it's only a little income, but at least it's continuously steady. And don't look for these fantastic deals where you think you're going to make a bunch of money when, quite frankly, slow and steady is the way to go.
Yeah, and it's a general, like I would say, it's a general real estate thesis. I would put it this way, right? Because again, once you start to chase things, right, and you think, oh, you know what, we're gonna go and build right now, brand new something, blah blah blah. It's gonna be just amazing, high ceilings.
Yeah,
Okay, try it, right? And then that's where you start to lose the money, actually. That's where you start to lose the edge of it and saying, oh, you know what? I start to chase the return. They promised me this much, right? And then, so instead of going boring and then making a little bit less, but again, there's no secret, right? There's a risk
right,
return. And then every time when you take more risk, right, there's a little bit more return. But the question is, if that's going to be buildable, if that's going to be finished, right, if that's the project people will be like paying for 2 years from now when they finish and stuff like that. And those X factors, they play like really hard, when, 3 year passed and you're like, oh, you know what? I should be a little bit more smarter with my financial decisions, right? Because again, so taking more risk, more reward, but then it might never happen, right?
right, right. Well, this is fantastic. So, Igor, where can people find you if they want to do a nice, steady income transaction?
Invest them, yeah. So it's going to be at avistafund.com. So they can go ahead and visit our website. So there's a portfolio, latest deals for the last couple of years. And then there's a news always. They can go to LinkedIn always. It's Igor Shaltonov, and they will find me there. So we have I would say a weekly newsletter. They can connect through us that. And yeah, just on a pro investing show as well. I have my own podcast. I usually interview because my passion is sports, and I interview the ex professional players, right, which is very fascinating. And I
But
find
let's go there for a minute because you are a water polo pro. At least in Moscow, you were there. Unfortunately, there's no water polo professional league in the U.S. But any rate, you are a sports person through and through.
yes. What
Yeah.
do you want? What do you want me to cover here?
Well, give us an example of someone you've interviewed that people would be interested in listening to.
I don't know. There's a NFL player, for example, MVP of Super Bowl, right? Malcolm Smith, very smart guy. So we talked to him about the what's next in his chapter, right? And he's really passionate about the business, and he wants to purchase business right now. There's a couple NBA guys that we talked to. So I really like the guess who transition, right? And the reason why, because the biggest gap you find when you stop playing. All right, and then that's when the phone stop ringing as well because you're not famous anymore, and then nobody
Right.
wants to talk to you because whatever was in the past, like it's irrelevant, right? In the future, like we're maybe in the present moment, and then you start to realize, oh, the life is different because it was a little artificial. The money coming in, they tell you what to do, where to travel, where to eat, and then all of a sudden the real life hits though, and then I feel like the transition of that, it's really fascinating because a lot of people will get lost and we help them to understand what's going on next, usually with life. Though.
Oh, that's yeah, no, that's fantastic. I'm going to go back and listen to some of these because that is an interesting transition going from professional sports into kind of basically retirement, and then what do you do with your life after that? So,
Yep.
any rate, always an interesting problem. Well, I think we're going to stop for now. It's great to talk to you, and I'm looking forward to talking to you again in 3 to 6 months and just kind of checking in and seeing how the market is going at that point.
Absolutely. Thank you, Bruce. Thank you for
Oh,
guys listening.
thank you, Igor. We'll talk soon again.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.